So we're talking about a international trade financing this week, and we talked about already the post-shipment financing, and today we're talking about pre-shipment financing. So the entire transaction actually started with a pro forma invoice, us, the importer, liking a product and asking the exporter to provide us with details of the product and the price and a little bit of details as to what it is. And then we went through individual issues of payments, logistics, insurance, inspection, the product description, legalities, and we found ourselves representation and some sort of intermediation. We then listed the parties involved with a letter of credit, and we said that it's always the importer and the exporter. And then we have several banks, the importer's bank, the exporter's bank, payment confirmation bank. And obviously that could be different banks involved with the transaction as well. We have a logistics company, we have the insurance company, inspection company about the products on each side. And then we have the governments for the importer, government for the exporter, and then any transit countries that we're going to go through. And then obviously any banks involved in governmental transactions as well, subsidies, tariffs, customs, all that. And then we have the payment confirmation bank. Then after we settle all of that, we actually go on to asking for the actual invoice. That's the actual purchase agreement. And at that point, we write a contract, international known as letter of credit. We define all parties involved. In fact, we make real copies for them. And then we define every aspect of our, or every issue of our transaction, and we make it as detailed as possible. And we specify the jurisdiction. We are also under the UCC regulation, and the banks will ensure that the letter of credit is as detailed as it can be. It will include the product details, transfer details, logistics, insurance, permission, customs, taxes, tariffs, and all that. The letter of credit will be signed by the importer and the exporter in front of the importer's bank and the exporter's bank, and they need to be correspondents, and therefore, they will be agents of each other, and so that's how the letter of credit becomes a solid contract. It's always irrevocable, and we have different types of letter of credits, but the types usually refer to as to the payment, the penalties, and then the maturity, or how long the letter of credit is good for, and then the confirmation of the payment. We said that the letter of credit can be due payment at site, which means when the goods are delivered to the ship or to the truck or the transfer vehicle, and as soon as they are on board, free and clear. If it is a letter of credit with a payment of at site, the payment becomes due. If the letter of credit is a deferred payment, then the clock starts ticking, and then you have as many days as a deferred days specified on the LC, on the letter of credit. So we can also ask, and overwhelmingly, we always have the importers providing a payment confirmation and the exporters requiring one. And a payment confirmation simply says that if the importer fails to pay, then the payment confirmation bank will be making the payment. And since the importer's bank can be the payment confirmation bank, which would be a lot more convenient because they're local, there's a reason why it's the importer's bank. They probably have a relationship, some sort of collateral agreement. That's usually the most common, but you can also have exporter's bank or an unrelated bank or unrelated third party guaranteeing payment, requiring collateral, and requiring payment, some sort of a fee or commission for that payment confirmation. So then we talked about a simple transaction in India or in the US, and we talked about the post-shipment financing, and there are two types of post-shipment financing. The first one is actually based on the if the LC is a deferred payment, in which case, because it's a deferred payment, the importer has 30 days to pay, for this example. However, the exporter needs to get paid immediately. Perhaps the only reason the exporter agreed to this is because the importer has the upper hand, and it's the buyer's market. And then the second type of post-shipment financing we talked about is the LC is at site, and therefore the importer needs to make a payment immediately as the goods are on board, free and clear. At this point, the exporter has the upper hand and seller's market, and the importer will be needing the financing. Now, what I'm going to do now is I'm going to copy all this into a new sheet right here. Now the thing is, now we're talking about a pre-shipment financing. Now this actually is, oops, we don't really have a number one or number two for this, and we'll talk about who gets financing and who pays for it, blah blah. So whether this LC is at site or at a deferred payment usually does not make all that much of a difference for a pre-shipment financing. So the idea now is that pre-shipment financing requires a payment before the goods are on the ship, free and clear. So one of the nice things about the post-shipment financing, either number one or number two, or with a site or a deferred, is that the goods are on the ship, free and clear, which means from a payment perspective or a financing institution perspective, you really are not taking all that big of a risk. The goods are finished, and there are no reservations on it. There are no disputes on it. And if anything happens on the way, insurance will cover it. There are no governmental sanctions or restrictions on it. It's free and clear. So a post-shipment financing usually has very little risk involved with it, as everything is pretty much airtight. Whereas the pre-shipment financing, you don't even have the goods. So, say for a farmer who's actually, say, shrimp farmer in Louisiana, as an exporter, you're basically saying, I need a payment so that I can start growing the shrimp. I can buy shrimp feed or, the seeds or whatever. So the baby shrimp. So the idea now is that from the exporter's point of view, I need money to start producing. So for instance, if you're a carpenter, you need money to build the structure. If you are a farmer, you need money for, labor or seeds or fertilizer and whatnot. So, and you basically need the money to build or to produce the said goods. From an importer's point of view, well, I need to provide this money, otherwise it won't get built. However, what if I give him the money and then we have significant issues? Going back to our original problems, we might have an issue with payment. We may pay, and then we may not get anything back. There really is, there are guarantees, but you still are counting on somebody's performance. So how are you going to get that person to produce after you make even a partial payment? We have product-related issues, significant issues. I pay the money, and what if the carpentry product is subpar? What if we do not agree? Remember with the actual letter of credit, if anything was wrong with the product, damage or any sort of conditional issues, we might actually put reservations on it. We might renegotiate the price and everything. However, with the pre-shipment financing, we're basically making a payment and we're hoping that the product will be delivered on time as expected, with this expected quality, and every legality attached to it. So there's a lot of unknown to it. However, the LC can be right. So there's a lot of unknown to it. But again, from an exporter's point of view, unless I have the money, I cannot produce. And the example of carpentry kind of fits in nicely. Like, as a carpenter, I have a shop, I have a reputation, I will build it, but I need the money to buy the material to build it. From an importer's point of view, what if I give the money and he builds something that's subpar? What if he doesn't meet the scheduled deadline? What if there's damages to product? What if the color doesn't match? Things can go wrong. What if he's a fraud? So this is a significant dilemma. So how do we fix this, right? And well, at this point, we actually have an issue of a performance guarantee. Unless, as an importer, unless I actually have some sort of a guarantee from somebody, I cannot make that payment. And from an exporter's point of view, unless I have that money, I cannot produce. So we are at a deadlock. So now, from a government perspective of the exporter, if the exporter does not have this business, he will not produce. If he does not produce, then he will not employ and will miss out. Our area, our community will be missing out an opportunity to produce, to make money, to earn wages, and to, have any or this specific business activity. So from a government perspective, I want this to happen. From an exporter's point of view, I want to sell my product. This is why I have my business. From an importer's point of view, I want this to happen. However, I'm not willing to pay unless, I have the product. So, there's a lot of willingness to work. However, that there's a problem of trust. So how do we fix this? So day one, we start with a pro forma invoice. In about 2 weeks, we have an invoice, say, for $100,000. And then we have the LC. Now we have an issue. In fact, I might actually take this little. So at around this time, the payment can be at site or deferred. But at this point, so I want to say about 1 to 2 months, the issue now is a performance guarantee is issued. We're going to talk about by whom. And then, say about 2 months, pre-payment is done, or let's just say sent. And let's make that, I don't know, say $30,000. And well, and then it depends on obviously how long it takes, say 6 months. Goods are produced. And then say 6.5 months. And say 7 months. Something along those lines. So as you can see, unless this performance guarantee is issued, the prepayment will not be sent. So let's explain what that means. Let's say that we are an unrelated bank. The exporter comes to me and says, I am a shrimp farmer. I have a buyer in Germany. We're in Louisiana. We have a buyer in Germany who's going to buy our shrimp. I have been doing this for 30 years. I have a good reputation, and I have never missed a delivery. So what I need from you is to tell the German importer that I will deliver. I want you to promise for me. Again, from a performance guarantee bank perspective, I'm being asked to provide a guarantee of performance, and a lot of things can go wrong, which simply means, the person can be a fraud, but, there's a reputational aspect of it. The weather may not be as good. It could be a hurricane hits, or it could be other, unforeseen events, and the farmer cannot or may not be able to deliver on time or as expected quality. So as a bank, this may not be in my purview. Like, for instance, how am I going to know the likelihood of a shrimp farmer making delivery? And what if he doesn't deliver? Like, what do I do? So I'm not equipped as a bank. I'm not equipped to write such a performance guarantee. So it's challenging too, because like I would need to do, in our financial curriculum, for instance, we almost talk about financial analysis. So if I am a payment confirmation bank for a post-shipment financing, for instance, the only thing I'm actually doing is I'm doing a financial analysis, a credit analysis, and determining whether the client is worthy of that payment or not. And if not, then I ask for collateral. I take his house, I take his car, I take his business shares or whatever. I take money, cash, bond, co-signatures, right? So as a bank, I know how to do all of this. But from a performance guarantee perspective, I need to evaluate whether the person is good for his word, whether the person can actually farm the shrimp on time, on quality. So as a bank, I'm not equipped to do this. Like, think about it for yourself. If you actually start working for a bank, you'll do all that financial analysis. You are learning this. But can you actually tell whether a shrimp farmer or a sugarcane farmer can actually produce as much quantity, quality on time? And the usual answer is almost impossible. And no commercial bank would be willing to do this. It's just too much risk, and um, I'm not even sure how the logistics would work from a bank perspective. So we'll look to the governmental sources. So then what we need is we need a government intervention, right? A government services of a government. So like I said, from a government perspective of the exporter, we want this transaction to take place because it creates business, it creates employment, it creates taxes, it creates a ripple effect in the economy. Like, a shrimp farmer buys feed or whatever they need to produce, and then all of those are industrial demands, and it actually has sub industries, and so we want this to happen. I mean, from a very least, we want that payment into our community, into our country. So, and I realize as the commercial banks, private commercial banks, will not be willing to take such risk because simply they're not equipped with that. We need a specialized bank. So now every country has uh, what we call export import bank. And in the US, we also have an export import bank. We also have some regional exim banks. And, you know, even though the countries have their own exim banks, you could also have individual states having their exim banks for a specialized products. Um, like for instance, we don't have it, but I think it would have made sense if we actually had an exim bank in Louisiana for sugarcane producers, uh, for for shrimp production, or say for Texas, I guess, if they had an exim bank for oil exports or gasoline exports and whatnot. So the idea is we need a specialized expertise to provide exporters with and with the willingness and the reputational and the financial guarantee of a bank. Now, we refer to Exim Bank or Export Import Bank as a bank. However, it is not a deposit institution. So it is not actually a bank where you can open an account and start getting interest. or have a checking account or a credit card. It is more about helping the business community with especially their import and export related businesses, but particularly in their export businesses. Let's see if we have an about page here. Let's go down a little bit. Right. So let's go to the solutions. So you can see that, they went by solutions by need, protect against buyer non-payment. You see now you're talking about an exporter for a post-shipment guarantee, right? And then borrow against export-related assets. This is, again, post-shipment financing. Remember how we actually had right here in post-shipment number one, we are the exporter. We have a deferred payment. The money will be paid in 30 days. We could actually go to the Exim Bank and we could borrow against export-related assets. The income that we're going to receive, or the payment that we're going to receive in 30 days, 60 days, 90 days, 6 months, 2 years. We just need, remember that we actually have are looking for somebody to make us a payment immediately as the exporter. And but we're going to be receiving that payment for the letter credit for the products that we send in 30 days. And then sell to foreign customers on credit terms. Now we're talking about this. Sell to foreign customers on credit terms, meaning we are actually selling to the exporters. I mean, we are the exporter. We're selling to foreign customers with a deferred payment. And this also allows us to get a payment immediately. And we actually, expect credit terms. But if the importer is not willing to give us that time, or if the importer is looking to get it financed, well, then the Exim Bank is providing us with an alternative financing scheme. Increase financing cash flow, alternative performance, and bid bonds. And see, now you're talking about. So support for international buyers. So see, does your foreign buyer need help financing their purchase, but their lack of options may endanger the sale? See, they're trying to motivate the actual transaction. They are trying to make it happen for both parties. So they're looking to see if the if the importer needs financing in any country, Exim Bank of the United States is saying that we may be willing to help, or we may be able to help them to make this sale if it's going to benefit our exporter locally, and if it's going to make it possible for this sale to take place. So this one is the alternative performance or bid bonds. Did your buyer request a standby letters of credit, but this tied up the vital funds needed to fulfill the sale? See, that's the pre-shipment, which means that we need an actual, let's get into that. So the Uniform Customs and Practice for Documentary Credit. So that's the that's the irrevocable letters of credit, and the 600. That's the International Chamber of Commerce Uniform Customs and Practice for Documentary Credits, 2007 revision for the LC. Now the idea is that we are looking to get some sort of a guarantee for our performance as the exporter. And what the Exim Bank is saying is that they are willing to provide such coverage, perhaps not as a, I mean, they actually have the bid bonds and the performance guarantee, but they also have insurance products, meaning they can provide insurance to the importer against the exporter's failure to perform. So, if the shrimp farmer cannot produce the shrimp obviously we cannot make them to produce the shrimp. As an Exim Bank, what am I going to do? Like, I can't make them to, have the shrimp ready. However, what I can do is once the prepayment is done, as the Exim Bank, I can provide the importer with an insurance. And with that insurance, if the goods are not delivered on time or subpar, sub-quality, then the importer has some sort of a plan B, a fallback position in which he would be recompensated. He could get his money back and perhaps a little bit more, so that his expected revenue stream would also be covered. And again, you have to think about it from an importer's point of view as well. I need the shrimp because I'm going to sell it in my country, right? So in our example, we produce the shrimp in Louisiana, we're selling it to Germany. The German importer is thinking, if I have the shrimp, I'm going to sell it. I'm going to make money with it. I'm going to have profits, and I'm going to have my retail or whatever, operation run with that shrimp import. So if the shrimp is not delivered, it's not just that I lost the prepayment, but I also lost the subsequent revenue stream that's going to create X amount of profits for me. So in that case, just making sure that shrimp is delivered is the best case. But if that cannot be happening, then I need my money back. And also I need some sort of a coverage for the loss of profits in this situation. So the Exim Bank, is basically provides this service for us in the US. And like I said, every country actually has an Exim Bank. I mean, most countries, and sometimes you actually have regional Exim Bank. So let's click on this about Exim Bank and just see what they're saying. So the Export-Import Bank of the United States is the official export credit agency of the US. Exim is an independent executive branch agency with a mission of supporting American jobs by facilitating the export of US goods and services. Even though the name is export-import, the idea is that the only time, or ideally, when Exim Bank needs to finance the importer is when that import is leading to an export, right? So, like for instance, in my experience, when I worked in banking, we used to import the sewing machines from Italy, and those textile machinery were used to produce textile, which in turn Turkey exported, or our clients exported. So when we were importing these machinery, we used the Turkish Exim Bank credit facilities and financed it through them as a bank. And then, and our justification was these machines were used to produce textile that in turn were exported. And that's a very specific example, but also we are looking for, the import or financing the importers so that the export could take place. In the case of the post-shipment financing, unless the, pre-shipment financing, unless the performance guarantee is issued or a bid bond is issued, or the importer is provided with some sort of insurance that the exporter will carry out his duty, his required production, the export will not take place. So in this case, the Exim Bank of the US will facilitate the needs of the importer of another country. And only then this export transaction will take place. And if you think about it from an insurance perspective, your risk is still in the US. You're selling the policy to the importer, and a lot of times probably the premium will be paid by the exporter, and only then the prepayment is sent, and then the exporter produces, and then based on that production, the goods are produced, delivered, and the goods are fully on board, and then the remainder payment is done, and life is good. So, right. So, see, again, only when the private commercial banks are unable or unwilling to provide the financing. And like I said, it's not always about being unwilling. Banks will do anything that makes them money. However, how am I going to judge as a bank? How am I going to judge or evaluate or analyze whether a shrimp farmer can carry out his duties, his responsibilities with respect to the LC? And that becomes a significant capacity issue. As a bank, I'm just not able. So that's why Exim Bank provides this service. So working at the Exim Bank, it is rather a fine. See, let's take a look. It is rather a finance job. However, notice how they actually have engineers that they want to hire. And then they have economists and attorneys and resource management. Um, so it is not always a specific finance job, right? So at at a normal commercial bank, you're looking at specific finance jobs, the credit analyst, So, but with the Exim Bank, it's yeah. I mean, you have loan specialists and all that, but you will have, like I said, specific. You need somebody at the Exim Bank who knows the shrimp business, who knows the sugarcane business, who knows the oil business. So you need, agricultural, say, mining, electronics, civil, mechanical engineers that would actually be involved and give opinion as to the viability of businesses and the insurance side of it. And you also have to understand Exim Bank is also an insurance agency in a way that they actually provide insurance for export related businesses. So even though we call it a bank, it really is more of it's not a deposit institution, and it's more of a very much like an investment bank, for instance. They provide services for their clients for the betterment of the exporters. So that's it for the pre-shipment financing, and we'll continue our discussion with the international agencies. And I want to go over the quiz for on Friday. And if you have any questions, please let me know. And thank you for working with me. I hope to see you all soon. And thank you. Have a great day. Bye now.